Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value, and I was scrolling through the comment section. I have a comment up at the top here. Actually, I can shrink me just a little bit. You guys can read that. It says, "Hello Andy, thank you for your great videos. I bought some platinum yesterday to add to my gold, silver, and uranium. Good job there. Our nation, the Netherlands, is experiencing an insane rise in housing prices, a house costing $500,000 instead of $300,000 like 3 years back. Several times now, I've seen you point out that we will soon enter the real estate expansion phase. Will the increasing supply reduce housing prices from that point onward? Could you do a small segment on housing prices in these cycles? I'm not a real estate investor, just very curious." So the most explosive moves in a real estate cycle is the time that we're in right now. It's the recovery phase to an expansion phase. And I'm going to show you a whole bunch of data here. I'm going to show you what the real estate cycle is, where things start to heat up, where they start to cool off. And then I'm going to show you why this is all jacked up, why it is so messed up, our housing market, and how this could be a massive increase in home prices. Now, there could be short-term blips in terms of forbearance, moratoria. There are things that we've never seen before. But on the long term, with how many homes we are short, we can't just shift ownership in the homes. We have to actually build our way out of it at some point. Shifting, I mean, if someone goes to sell a house, if they come under financial pressure, they'll just sell it and someone else gets the house. It doesn't actually create homes for more families to live in. It just shifts ownership. So it can delay prices because it will be a short-term, we'll call it a short-term amount of homes that come on, and nobody knows that amount. But we still have to build the shortage. And I'll show you the shortage in the build. And I'll also tie in some valuations. So you're going to lose me, and we'll focus on the presentation here. It says the U.S. is facing a shortage of nearly 4 million homes as builders struggle to meet exploding demand. The estimates are usually between 3 and 4 million is what we're short because of what we didn't build in the last real estate cycle. And I'm going to show you through the real estate housing starts why we're short those homes and how this cycle basically works. So what we're looking at here is new privately owned housing unit starts. It's basically single family homes. The cycle average is this dark line that I have going across here. That dark line is the average that we should be building roughly per year. The housing cycles above and below that average. And what I have here are these dark shaded in areas. This is green. This is a different color. Oh, it looks like I accidentally, this is supposed to be all red. And this is yellow. So what happens is the area under this curve, if this is the average, needs to basically average itself out unless there's a demographic boom. What happened here is we were cycling up and down, kind of very controlled, which is good. And we don't want these large imbalances. Now, what happened was we threw a commodity buy signal in the beginning of 1970, signaling that commodities were cheap. We haven't really had a large expansionary phase in the 60s. It was basically a lower inflationary period. What happened was we started to print a little bit of money, and we came in, and this money could get into the system through real estate. An expansionary phase of real estate. Spending and velocity and home prices all went up during the 70s. And you'd say, okay, you have to kind of look at this from a root cause. Why did home prices go up, and why was it inflationary? And why did the velocity kick up a little bit? It's because of the demographics. The demographics in the United States is larger, and in the 50s, they were all born in the 40s and 50s. And they became into home buying years in the 70s. And that's why the 70s really blew up, was because of the demographics of the baby boomers going in and buying homes, having kids, and spending more money. That's your velocity, and that is your increasing in money supply. And if you were to look at these basically movements, they correlate with the M2 money supply. They are very, very, very tightly correlated, especially in history. They're basically the same thing. Inflation is just lagged by 1 to 2 years behind this housing starts data and the M2 money supply. Inflation's just lagged a little bit. Now, we also had, so commodities got expensive. They got expensive and they topped out in late 1970s, 1980. Precious metals topped out. Basically, they were overvalued at that point. We could have went back on a gold standard in 1980 if we wanted to, 100% gold-backed currency. Everything was accounted for. So we were going from an overvalued state to an undervalued state from the 80s onward. And it took from 80 to 2000, 99, 2000, somewhere in that range, for that to get completely worked off. And that's when the commodity to stock ratio threw another buy signal, was in 99, 98, somewhere in that range. This cycle, if you notice, whenever you go below it, you got to build above it at some point. We went below it here quite dramatically in the 90s. We had to go back above it. And we went too far above it here. We built too many homes in the mid-2000s. We went into a hyper supply phase. And what happens is you're going to get the largest amount of real estate gains right here where we're going into an expansionary phase. What you're doing is your inventory is getting eaten up in the recovery phase. This recovery phase here, your inventory is getting eaten up, and then prices start to surge in this area here. Prices start to go up, kicking on the expansionary phase, which means that we have a demand-supply imbalance, and your inventory is getting eaten up in the 90s here. And then in the 2000s, we went into an expansionary phase, which kicked on the housing starts. And remember, this stuff isn't super fast. It's not like one day it happens and the next it doesn't. This is a long-term outlook. It takes time. It may take a year or two for inflation to really start being realized by the markets and their perceptions start to change. We are still somewhat early. We're not early. Early would have been buying right in this time frame in here in 2016, 2017. That was when commodities did the full-on bottom for most stocks and mining companies. But we are coming up into an expansionary phase. Here's the problem, though. When we did this expansion phase last cycle, we ran into a lot of problems. The government basically gave out a bunch of loans, which they should not have done. And what happened is the demand and family units, the families are still gathering at the same amount. The problem that happened was we had all these loans that should not have been loaned out. A lot of them went bust and they foreclosed because they went underwater. Their loans, basically they owed more than what the loan was worth, and they said, foreclose it, I don't care, I'll give it back to the bank. And that's what happened. We also had on top of it too many new homes being built. And we had this massive amount of inventory come onto the market. It went all the way up to 10 months of inventory, roughly. And all these homes came on, and it basically killed the housing starts. The housing starts went all the way down to like 500,000. But remember, we still had 1.3-ish, 1 million to 1.3 million people, families being gathered. We still needed to build the homes. The problem was the housing builders couldn't make money because of the last crash here. And so many homes came on the market, foreclosed, short sales, all that stuff, that the new homes couldn't compete with it. They were too low. The deals were too good. If you knew what was going on, the best time to buy a house was 2010, 2011, 2012, 2013. You could have got massive deals on homes. You could have absolutely set up the best purchasing time for anyone's lifetime in terms of home affordability in this period because of how stupid they were in giving out these loans and what they created. Now what they did is this yellow area under the curve here, below this average, this area here, all needs to be built at some point in the future, which is coming up right now. And right now what you're seeing is the inventory, and you can verify this anywhere, your inventory is so low that prices are rocketing higher because there's too much demand for the supply that's on the market. They can't build the homes fast enough to keep up. That's the problem. We have a labor shortage. All the labor that built these back here cycled out, and this was a long cycle. It's not like you're training all these people to build homes in a 10-year plus bear market. So we need to get the labor, we need to build the homes, and it's going to take some time. The estimate that most people have is a peak in 2028. Now, home prices go up the most when you run out of inventory and you try kicking on the real estate cycle. They go up the most right now, and it will probably last for 4, 5, 6, 7, 8 years. It'll peak out at the top of the expansionary phase. This over here will peak, your inventory will start to increase, and home prices will level off and potentially maybe even go down, depending on how much inventory is built. So this cycle here, you're going to see slow increases in home prices through here, the first half. It's slow because you're eating through the inventory, and inventory is not a problem yet. There's no way to kick on the housing starts. The housing starts or expansionary phase may go sideways for a little bit depending on how much inventory you have. Then it really starts to ramp up after you eat through your inventory. So when your inventory goes away, home prices rocket, and they rocket higher until you get the housing expansion phase built and your inventory is replenished. We are in an expansionary phase. We have low inventory, and right now is the lowest risk spot for home price increases. Here's the phases looking at it. You've got a recovery phase, an expansion phase, a hypersupply phase, and a recession phase. And it just cycles back and forth. This is where your inventory gets rebuilt, is your hypersupply phase. This is where inventory basically is zero. It's very low. And then you kick on the housing starts in an expansionary phase. The housing starts kicking on and building more new homes than the average, which is called an expansionary phase, is an inflationary period. You get new loans from banks going against new homes. That is inflationary. That's where the money's being created. That asset, that new house, didn't exist before, but now it has a loan against it. It's a new asset. It's a new loan completely. It's not like an existing home that may have had a loan on it where someone else buys it and then they get a little bit bigger loan. This is a completely fresh new loan, and prices are going up. It's usually a pretty large loan. So it's very inflationary. So what you look at in history, and I'm going to go back here, every time you have a decline in real estate, you can see this dark lines here. These are recessions. So what it's saying is when you bust in real estate, you have a deflation or recession. And notice, bust, deflation, recession. A bust, recession. A bust, recession, bust, recession. We came down, recession. We have one that's an anomaly, which is the NASDAQ 2000 bubble. We had a bust here, recession, and we had the whole economy was stopped here, and that's why it went way down, and that's why you see this little recession line. One can gather from just looking at the housing starts and where the recessions are located here, one can conclude that real estate is the driver of deflation and inflation. That is my conclusion. And when you check up and look at prices, when you backtest prices, stocks and tech stocks do well in recovery phases. It's low inflation, low interest rates. Expansion phases end with high interest rates and inflation. Inflation kicks on a higher interest rate because of the real negative rates that are created. Real negative rates just means that inflation is higher than the interest rate, and it becomes a real negative rate, which will increase interest rates through time as inflation increases. This expansionary phase is great for commodities, especially if you have alignment when commodities are cheap. If commodities are cheap at the beginning here, you have a perfect alignment for commodities to revalue themselves higher against stocks. You're going to see a rotation of money as interest rates go up. That's what causes the undervalued to overvalued state. It's the rotation of money between stocks and bonds and commodities. It's rotating between them. What we have now, since we are at very low interest rates, is I propose that interest rates are going to go up. You're going to see even a larger rotation of money out of bonds and stocks because of interest rates going up into commodities. And here's our commodity to S&P 500 ratio. These are buy signals when they're cheap, sell signals when they're expensive. And we are at a cheap area, a very cheap area. In fact, here's the real-time data. We're at 0.0483. 0.0483 is like zero. We're down here because COVID created this very large imbalance. We've never been this cheap in 100 years of stocks in relationship to commodities. So what I am proposing here, given the expansion phase and how dorked up it is, this has never been this out of whack. Never. It is so far out of whack that we're going to have to build a ton of more homes. It's either going to be a longer expansionary phase or we're going to have to go higher and build a lot more homes, which is going to be more inflationary. The higher this goes, the more inflationary it is. It'll be like a punch of more inflation. I don't know how high this is going to go. I don't know how quickly we can ramp it up, but it's going to be inflationary, whatever we do. It could be slight inflation for longer or a big punch. But we've never been this far out of whack. Now, this is what it looks like for the CRB to Dow Jones. This is the downtrend here. We broke the downtrend line. We back tested and we're coming back up. And if we break this point right here, we're in a new uptrend, which we're right at right now. We're basically forming a new uptrend right now in commodities. It is a verified, valid new uptrend. We're putting it in right here. All we need is commodities go up a little bit more and we break it. This here, if we have higher interest rates, all the money from bonds and stocks, last time we were in a declining interest rate environment, a 40-year decline. This time, I think we're hitting bottom and we're going to come up because of the undervaluation that we're seeing here. It's so undervalued and how bad this is messed up. I think we're going to kick off a very big inflationary cycle and we're going to see interest rates go up for a while from this chart right here. So we're going into this new phase and we're at 0.0. We're all the way down here. We're so low. We're almost off this chart. We're right at zero. We're hugging the line of zero. Commodities are radically undervalued at 0.2. And 0.2, if I were to do some analysis here, just to show you, we're at, so 0.2 divided by 0.05, we're 4 times, we're 1/4, we're a quarter of where they consider commodities to be radically undervalued of that line. We are a quarter of it. We've never been this low. This is, we are so far out of whack. I don't know what the heck's going on here. And what's going to happen is what I'm proposing is there's such little downside in commodities, and I know they're volatile. A lot of these companies they're insanely volatile. And that's something that you're going to have to get used to if you want the returns. Volatility equals massive returns if it works in your favor. What I'm saying here is that we have a housing market that's messed up because of the last cycle. We didn't build enough homes, and now we have to go into a very large expansionary phase of home building. That's going to take probably 7 to 8 more years, somewhere in that range. We have never been this out of whack with commodities. So we have housing market that's never been this out of whack. We have commodities that have never been so far undervalued. And precious metals, if you guys like precious metals. They've never been this low in relationship to the monetary base, in relationship to stocks, in relationship to other assets. When this money rotates, when we get interest rates to start to go up, money's going to say, I don't like losing, with the real negative rate, inflation's high, interest rates low, and you're losing purchasing power gains. They're going to say, I don't like this. I'm going to sell my bonds, which increases interest rates. And then that sparks the rotation of money. The stocks pay about 1.5% dividend right now, 1 to 1.5. When interest rates go above that, I think that's when stocks are going to start to decline. About 1 to 1.5%. About 1.5% is probably that area. We start going up to 2%, 3%, 4% in interest rates, and people are going to ask, is that going to hurt the housing market? It won't. It's going to hurt affordability, but it won't hurt the housing market because if people want to own homes, that's the only gateway to get it. You either have a house or you don't. You either fight with very high rent prices because rent prices are going to go through the roof. They are going to go way higher. Housing prices are going to go higher too. And then people are going to be put in a situation where they say, Do I pay $3,000 or $4,000 a month in rent, or do I just go buy a house? And again, in an inflationary environment, labor prices go up. The price of homes go up. Everything goes up. Home affordability is going to go down. It's not going to get better. We are at the bottom of home affordability in 2012, 2013. That was the bottom. We are going to come up in home affordability. And the reason is we have a bunch of buyers looking for homes that don't exist. And now they're all competing against each other. That's how prices go up. And now they're hitting new homes. New homes have backlogs of 18 months in some areas. 18 months, they are booked out. This could be a very big inflationary period. Now, here is the problem that most people have as new investors. They're going to look at this data and they're going to say, this guy just said that commodities are going to go higher. And I agree with this, but we are looking at this from a 40,000 foot view. We're way up there looking at all this. And then what people do is they'll look at things and they're right up on it. Day-to-day movements doing this, or month-to-month movements are even very short term. They're looking at everything and they're seeing it go down in a small pullback and they're saying, this guy's wrong. What you need to do is you need to back up. You can't look at the day-to-day movements. You can't even look at the week-to-week. You can't look at the month-to-month. We have to look at this from year to year to year. And you need to look at the big overall trends. Invest according to the big long trend and hold on. That is my strategy. Because when this housing market continues to go higher, and I know there's a lot of people that say it's in a bubble, problem is there's no homes. How can you be in a bubble with inventory as low as it's at? Inventory can get better because we're coming from extreme lows. You're going to see home prices decline, or home sales decline, because there's not enough homes to create more sales. So some of these numbers and some of these metrics, you could listen to it, but it may not be 100% right in the picture that they're trying to paint. Home sales could decline in its aggregate because we don't have enough homes to sell. We are that low of inventory. Prices are going to continue to go up. So look at home prices, days on the market. If those two things in inventory, prices, days on the market, don't really look at sales. Those three things, if inventory starts to go up and home prices start to level off, then we're cooling off a little bit, which we'll probably do anyway. We're not going to go up at 24% year over year every single year. But we could see high valuations. We could see some pretty aggressive moves higher, continually, like 10% plus for a while. And home prices are going to get very expensive and unaffordable. If that happens, the commodity sector will absolutely kill it. Homes will be a good investment, real estate will be a good investment, and commodities will kill it. And we're seeing that in the charts. We're seeing everything start to bottom and break patterns to the upside. It's game on. If you focus on the short term, you're not going to ride this commodity bull market higher. It's just the way it is. Where I'm playing it, and I know a lot of people ask me how I'm playing this, I like uranium, I like oil and natural gas, I like copper, I like platinum, I like silver. Gold's good too if you're a big gold bug, go for it. Precious metal mining companies and all that, they're good. I like the royalty companies the most. Tin's another one that I like a lot. The diversified mining companies are really good. Those are where I'm hiding out in. If you want to buy stocks, non-dollar denominated assets like emerging markets in Canada, in Australia, they should all do very well because the dollar is going to get weaker. I'm looking for a weaker dollar. The thing that can break this is if the dollar goes way up. If there's some problem, and it would be short term because we have to build these homes. That's my opinion. But in the short term, if the dollar gets stronger and we have some sort of problem, they shut something down again, then we are going to see further downside. I'm not going to sell. I'm going to buy more. I'm going to continue to cost average in. I don't think we'll go down to where we were when I bought. Now, what would you do now? I'm looking for this stuff to turn back up over the next month or two, and then I'm going to be a buyer again. I'm going to continue to cost average in. I'm not going to be afraid of what other people's opinions are on YouTube or wherever else. Irrespective of what degree they have, does not matter. They have to have a valid, logical argument against what I just proposed here, where I missed something or something happened. So That's what I'm going for. This is my thesis. This is kind of what I did. I didn't really learn this from anywhere. I just pieced it all together myself. It took some years. Hopefully you guys like this content. Give me a thumbs up. Thanks for listening. This is Finding Value.